gold going up. It's the dollar going down. It's the
Yep.
euro, it's the yen, it's the pound. All of these currencies are going to lose purchasing power. And so I think, treasuries are not going to be suitable for portfolios. So what are you going to buy as an alternative, as a low risk store of value safe haven? I think gold is going to be what ends up replacing treasuries. Gold's an
Mm.
inflation hedge. It's a hedge against the debasement of fiat currencies. And so you're more likely to debase your currency with a war.
With the current geopolitical changes, gold is surging at a record pace, marching aggressively towards $3,000. If the market favors the yellow metal, it may soon surpass leading assets and spark a massive price rally. With the central bank gold buying spree that thrived this year, gold reserves in world banks have reached their peaks, with the yellow metal holding up a nearly 16% share as a leading central reserve asset. At the same time, the US dollar reserve share value has dropped significantly. The USD reserve share dropped 58% as Eastern market trends promoted a new market paradigm of replacing fiat with gold. Schiff highlights that, even though gold is having its best year in 45 years, with the last similar performance dating back to 1979, demand hasn't surged as expected. Business is steady, but far from booming. He sees this as a very bullish sign. Normally, rising prices trigger a buying frenzy from the public, but this time, investors have been selling into the rally instead. In August, central banks continued to add to their gold reserves, reporting net purchases of 8 tons. Although overall demand has slowed from the peak levels seen earlier in 2024, gold accumulation remains positive, particularly among emerging market central banks. August net purchases marked the lowest level since March, when central banks recorded a net sale of 2 tons and were significantly below the 12-month average of 33 tons. Schiff forecasts that by next year, US and European buyers will return to the gold market, and institutions like pension funds and endowments, which have largely overlooked gold since the 1980s, will begin adding it to their portfolios as a diversification tool and an inflation hedge. He stresses that gold acts as both a hedge against inflation and a safeguard against the debasement of fiat currencies. Ready to dive in? Before we do, take a moment to like and subscribe if you're enjoying the content. We're so close to hitting 1,000 subscribers, and with just 11% of viewers subscribed, every click counts.
2020 was a very good year for physical gold, but we haven't seen any kind of pickup this year, even though the price of gold is having its best year in 45 years. The last
Yeah.
time gold had a year this good was 1979. Yet, despite that, the phones are not ringing off the hook. I mean, it's business as usual. And I know when you look around the industry, gold ETFs into the rally the entire time. I know even the ETFs for the gold mining stocks, like a GDX or GDXJ, have had net liquidations during this year. Normally, the public is encouraged to buy when the prices are going up, but not this time. They've been selling the whole way. And to me, that's just a very bullish indicator that the little guy isn't even participating yet, that the main buyers are foreign central banks who are a lot smarter than retail investors in the U.S. and probably, individual investors maybe in China or India, some of the BRIC nations, they're a little bit more astute over there. And so they're probably buying some metal. But I think that, by next year, you're going to see the U.S. buyer, European buyers coming back into the market. And I think you're going to see the institutions, who haven't really been in the market, pension funds, the endowments, the big money hasn't even looked at gold probably since the 80s. And so I think they're going to come back. I mean, I think it's going to be reintroduced into portfolios as a diversifier, as an inflation hedge. It's going to fulfill the role that U.S. Treasuries have been fulfilling, because people have looked at Treasuries as a kind of a safe haven, risk-free way to park some money. Well, Treasuries are extremely risky. The government's going to hold the yield well below the rate of inflation. So anybody who holds Treasuries is guaranteed to lose. And so I think, Treasuries are not going to be suitable for portfolios. So what are you going to buy as an alternative, as a low risk store of value safe haven? I think gold is going to be what ends up replacing treasuries. Gold's an inflation hedge. It's a hedge against the debasement of fiat currencies. And so you're more likely to debase your currency with a war. And it's actually twofold. I mean, depending on how big the war is, but wars can result in a destruction of goods, right? There's, a destruction of productive capacity. So you have less supply of goods in a war. And a lot of times, if it's a big war, you have to produce ammunition. You have to produce military hardware at the expense of civilian consumer goods. So wars tend to reduce the supply of consumer goods, but they increase the quantity of money because governments today don't want to pay for wars. They don't want to tell the taxpayer, we're fighting a war, so we're raising your taxes, or we're fighting a war, so we're cutting your Social Security benefits. They just want to say, we're fighting a war, just keep on spending money, and they go out and borrow, and they have bigger deficits, and so the Fed has to print more money, or the ECB, or the Bank of Japan. So wars lead to money printing, inflation, and that's why people are buying gold, right? And so anytime the hostilities pick up, it's more likely that the currencies are going to lose value, and you want to own gold.
After ending 2023 well above the critical $2,000 per ounce level, gold has continued its upward trend in 2024, reaching new price milestones each quarter. In September, gold surged to a record high, surpassing $2,600, following the U.S. Federal Reserve's decision to cut its benchmark interest rate for the first time since its aggressive rate hikes began in 2022. While this surge has thrilled many market observers, there is some disappointment that gold mining stocks have not outpaced the metal's rapid ascent. Peter Schiff explains that gold typically reaches a new high before gold mining stocks follow suit. However, during minor corrections in the gold price, the mining stocks tend to drop sharply, sometimes by 10% to 20%. Nonetheless, Schiff believes the present environment is highly favorable for gold mining companies. With the dollar index still above 100 and gold approaching $2,600, he argues that mining companies stand to benefit greatly from the strong gold prices, even in the context of a relatively strong US dollar. Now, let's redirect our attention to a video.
It's just that normally in a bull market, you would expect the gold stocks to lead the metal, that they would anticipate higher gold prices. And so they would incorporate that into the price, into the PE multiples. But what's been interesting or unique about this bull market is that the gold mining stocks have lagged and they constantly have to catch up. Gold will go up and make a new high, and the gold stocks will eventually go up. Gold will have a small correction. Maybe gold drops 50, 100 bucks. Gold stocks will get killed by 10%, maybe 20%. Then gold will make a new high, and gold stocks will start to come back up, and then it keeps making new high, new high, new high, and then eventually the gold stocks make a new high, and then gold has a correction, and the gold stocks get killed again. And so they're really having a hard time outperforming gold like you would expect them to do. And I think that's because nobody believes this bull market. They've been bearish the whole way. It's been climbing the mother of all walls of worry. I think that is going to change. I mean, you look at the big gold stocks like the Barrick and the Newmonts, they're trading at discounts, sharp discounts to the S&P 500. They historically traded premiums. And so they're cheap. The gold companies are priced to book. They're historically low. So there's a lot of bargain here. And I think that we're going to start to see the gold stocks coming in with some big earnings beats. Third quarter, I think this quarter, and especially Q4, which we'll get those numbers in next year. But I think we're going to see big beats. These major companies are going to be announcing increases in dividends. They're going to increase share buybacks. Then you're going to start to see some consolidation, more acquisitions. The market is eventually going to really go up. And, one of the problems that the gold stocks have had is that they've been an ironic victim of inflation. And it's ironic because you would think that they would benefit from inflation. But inflation drove up the cost of mining, but the price of gold didn't go up commensurate with that. Even though it's gone up a lot, mining costs have gone up even more. And I think that that's changing. I think you're going to see gold going up a lot more than the cost of mining it. In fact, if you look at oil today, oil's at an all-time record low priced in gold. You can get almost 40 barrels of oil for an ounce of gold. That's great for gold mining companies. And the wages now are not, running because they're not, the US dollar has not been that weak. Normally you have a weak dollar relative to other currencies in a gold bull market, but we've had gold moving up with the dollar, stable to firmer. Although it's been weakening recently, it hasn't really gotten killed. The DXY is still above 100. And so you wouldn't have thought that we'd have $2,600 gold with a dollar index still above 100, but we do. But that's great for the gold mining companies because their wages are not in dollars. And so I think they're going to really start to make up for the lost ground. And Wall Street is completely off guard. Nobody really is following this sector. In fact, earlier this year, back in February, March, several of the brokerage firms downgraded Newmont, downgraded Barrick to basically sells when gold was just about 2,000, and those stocks hit multi-year lows. Earlier this year, you had multi-year lows in the largest gold mining companies. I mean, I took advantage of that. I was buying more myself, even though I already owned a lot. I couldn't, help it. I had to buy more because I wasn't going to, let that gift just go away. And I was pounding the table on my podcast back then, telling people you got to buy these stocks when Wall Street is giving them away because they're basically capitulating. And I remember when they downgraded, was it Barrick? The analyst said, "I'm downgrading it because I don't see any upside potential in gold. Gold's at 2,000. It's fully priced. It's not going to go up. So why buy a gold stock when gold can't go up?" And of course, then gold had its best year probably since that guy's been alive.
Central banks worldwide have demonstrated a strong appetite for gold, with 2024 being labeled the golden year due to their aggressive accumulation. In the first 6 months of 2024 alone, central banks added nearly 483 tons of gold to their reserves, marking a 5% increase compared to last year's figures. In contrast, data from the Atlantic Council reveals that the share of US dollars in global reserves has seen a significant decline, dropping by nearly 14% over the past century. Why do you think central banks are ramping up their gold reserves in 2024? What might this signal about the future of the global economy? Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.